If you stumbled across this video and you haven't already seen part 1 and 2 of the How to Buy a Home in Silicon Valley series, I highly recommend that you go back. So click this video right here to go watch those videos first before you see this one. So much good content, so much fire in those first 2 videos. And you won't understand this video unless you watch those 2 first. So go over there. I would hate for you to miss the value, and then come back and watch this video right after you get done with those 2. All right, great. So now you finally made it. You are in contract on the home of your dreams. And there are a lot of different permutations and possibilities for you in this situation. You could have gotten into contract with no contingency. So I'll talk about what that means. You could have gotten into contract and have all your contingencies. So what happens? And so I'm going to walk you through every single little step of the process. And by the way, we actually have a private video series for all of Selling Silicon Valley Group's clientele. And I'm making this content available to you for free. All you have to do is text the word escrow to the number down below, and we'll send you our 10-step video guide on how to complete your entire escrow process, what to expect, all the little details. And if you text the word escrow to the number down below, we'll get those videos sent straight to your inbox. Well, first of all, what is escrow? I don't even know what escrow means. Escrow is an account that holds all of the money, and the escrow company is the company that manages the escrow account. And so they're a neutral third party. They're completely removed from the entire home buying, selling process. All they care about is making sure that you, the buyer, are now the person or the entity on the new title, the new deed, and that the seller gets their money, and that all the disputes and anything that happens kind of gets mediated and done through the title company. And so the title in this area, it's the title and the escrow company. They are combined into one. And so escrow is opened the day that you go into contract. Generally in Silicon Valley and in the Bay Area, it's fairly common to have a 1-day turnaround on when the earnest money deposit, or EMD, is supposed to be either walked into the branch or wired into the escrow branch. Traditionally, in a lot of markets, it can be anywhere from 3 to 5 days after contract acceptance that we are expected to, or we commit to wiring in that earnest money deposit. But however, because of the competitiveness of the Bay Area, the sellers want to know immediately whether you're in or whether you're out. And so by getting the EMD in within 1 business day, and by committing to that in your purchase agreement, the chances or the likelihood of you winning the home go up significantly. In fact, I can't think of a time in the last 2 to 3 years as a listing agent, when I've represented the seller, that we haven't ended up going with a buyer who had a 1-day EMD. And so that's a very simple term that you can write into the contract that's going to exponentially increase your chances of getting your offer accepted. What's the normal EMD amount? Well, typically speaking, the earnest money deposit is 3% of the purchase price of the home. So $2 million home, $60,000. You should have that money liquid while you are shopping for homes. This is not something that you should have tied up in an investment account or anything like that. Yes, your down payment can come from that. However, you want that money, that particular EMD, the 60K or whatever 3% is of the purchase price of the home that you're buying. You want that amount. You want that amount to be sitting liquid in your bank account so that you can transfer it within 24 hours of knowing that you got the home. Now, up until this point, everybody's home buyer journey is practically identical. And this is when it starts to, after putting the EMD in, is when things start to differentiate based on your circumstances. So before we even go into any of that though, it would be worthwhile kind of explaining what contingencies are and the 3 main contingencies in the purchase contract. A lot of times you are going to waive 1, 2, or 3 of these contingencies in order to strengthen the terms of the offer. But let's dive into what each contingency protects you from and what the steps are to going about removing those contingencies. So first of all, a contingency is a clause in the contract that keeps your EMD secure until you remove that contingency. And the 3 main contingencies in any marketplace are going to be financing or loan, appraisal, and inspection. Financing contingency we kind of covered in the last video, but just to refresh your memories for those of you who didn't watch that video and didn't take my advice and didn't watch that video, the financing contingency keeps your deposit safe while the bank underwrites your loan. Now, with the Selling Silicon Valley Group, using one of our preferred lenders, we actually have the ability, our lenders have the ability to underwrite your file before you make an offer, which means that when you go into an offer situation, the bank has already conditionally approved your loan. And so, because the bank has conditionally approved your loan, they've already committed to lending to you, which means you don't need a financing contingency, which number one, it strengthens your offer. And then number two, it gives you peace of mind when you go into the process that the bank isn't going to screw you over and say, hey, Sally, you can't buy a house anymore. No, that's not going to happen. The bank has said, congratulations, Sally, we're lending you the money, and you can go into any offer situation super confident and way stronger. But let's just say you didn't follow our advice, you didn't get pre-underwritten, and you're in a situation where you have a loan contingency. So in that case, the bank would underwrite your file, and generally speaking, that takes anywhere from 7 to 14 to sometimes 21 calendar days. And so in that time, the bank is going through your loan documents, they're going through your credit history, they're going through everything. They're searching in places you didn't even know existed. And so after they do that, they either come back to you and say yes or no. If they say yes, awesome. You can remove that contingency by way of a contingency removal form saying, I, the buyer, hereby remove this contingency. You have a deadline that you commit to in the contract. So typically in this market, what I've seen is anywhere between 10 and 14 days. And so after that 10 to 14 day period, the bank either says, yes, you got it, or no, you don't. And if you have your loan contingency, the bank says no. Well, the bad news is you didn't get the house because you didn't get the loan. But the great news is that your deposit's safe. And that's what the contingency is there for. Awesome. So that's financing. Now let's move on to appraisal. A home appraisal is the process by which the bank sends out an appraiser to the property, a person to the property to assess a value to the home. Think of the Antiques Roadshow that you see on PBS. When someone takes their grandma's 30-year-old vase or 300-year-old vase and they say, hey, how much is Granny's vase worth? And the person there says, well, it's worth X amount. That person is an antique appraiser. So same thing, same concept, but for home appraisal. Well, the thing is that every home appraiser is different. And by no means are we real estate agents home appraisers. However, we have access to the same data that the appraisers do by way of the multiple listing service. And so when you work with the Selling Silicon Valley Group, for example, we actually our job is to give you the worst case scenario. So when we enter an offer situation and we're going to be offering $2 million on a home, if we believe the home is only going to appraise for 1.9, we're going to let you know before you make the offer so that you are prepared financially to make that commitment if the appraisal comes in low. So any good real estate agent should be able to give you a reasonable valuation for the home before entering the process of making an offer and should be able to talk it out with you. Now, the good news is that if you have an appraisal contingency, and let's say the appraisal comes in short, you do have the ability at that point to try and renegotiate with the seller. If you can come to terms on a price that works for the both of you, maybe meet somewhere close to the middle of the appraised value and the value that you offered, that's great. But if you're not able to come to an agreement, that does give you the ability, the contractual ability to walk away with your earnest money deposit in hand. Now, going into an offer situation, if you know that you're not going to have an appraisal contingency, my suggestion is to really have that conversation with your agent, have that conversation with the lender, and have a team meeting and be like, hey, like, what if this scenario happens? And play a few scenarios out to make sure that even in the worst case scenario, without an appraisal contingency, you have the ability to close on the home and not have to be at risk of losing your earnest money deposit. And finally, we come to inspections. The inspection contingency is just like the other two, where you give yourself a certain amount of time, usually 7 to 10 days in this marketplace, if you're lucky, to do inspection reports. And what you'll do is you'll send an inspector out to the property. And by the way, you, the buyer, pay for inspections if they're done during the escrow process. So typically an inspection report for property, termite, and roof, all three combined, can cost anywhere between $800 on the very low end for a small condo, all the way to $2,000 plus for, a really large home. And so anywhere in between could fall anywhere in between. And you're going to get those inspections done within those first like 3 to 4 days. The reports take a few days to turn around. And then you get this laundry list of things that are wrong with the home. Let me be very honest with you. No home is perfect. And it's very common to find homes with a significant amount of work that needs to be done. Even a home that's 5 years old will have things that are broken, or have things that need to be replaced, or have things that have normal wear and tear. This is to be expected. Now, if you watched the previous video before, you'll know that we discussed the possibility, or the very real possibility in the Bay Area market, that most sellers get inspections done before they put their home on the market, which allows buyers to have a very educated offer, meaning they make the offer based on the knowledge that these things are wrong with the home. However, if you don't have inspection reports on the home, then you definitely want to do them when you're in contract. Now, by the way, this is worth mentioning right now because a lot of buyers don't actually know this, and a lot of your agents won't actually tell you this. But just because you remove your inspection contingency does not relinquish your right to get inspections done on the property. And so there are times when buyers, even though they waive their inspection contingency, they want to get their own inspector in there to cross compare and figure out whether or not everything on that checklist needs to be done, or what the most important items are for them to do when they get to the house. Now, there is no recourse with the seller at that point, but there are instances in which you will find a very major item that was not disclosed on the original home inspection report that is disclosed by your inspector, in which case you have the ability to then go back to the original inspector and do what every American does best: sue them. Now, I say that tongue in cheek, and maybe some home inspectors will hate me for saying that, but it's very true, and I've seen it happen before. Home inspectors have insurance policies, so if they miss a really big item, they should buck up and they should pay for it. You still have to close on the house, but you have the ability at that point, you have the legal recourse to go back to this original inspector and say, hey dude, you missed this $20,000 item that needed to be repaired. Someone's going to fix it. Someone's going to pay for it, and it's not going to be me. Assuming the seller hasn't done inspections and you get your own inspections done, you have an inspection contingency, and you find a laundry list of items that need to be addressed. At that point, you can ask for what is known as a request for repairs, which basically means, hey, you, the seller, we want you to take care of these items. That is the traditional way of going about asking the seller to take care of the items. However, in this accelerated, fast-paced market, what will typically happen is after you send in that initial request for repairs, the seller will come back and say, hey, what if we just offered you an X dollar credit to take care of some of these items, and we call it a day? In a lot of cases, buyers are happy with that because the seller is not in charge of doing the home repairs, the buyer is. And you might think, well, I'd rather have the seller take care of it. Well, the truth is that if the seller takes care of it, you don't know who's doing the work. At least you, the buyer, if you get money instead of the repairs being done by the seller, you have the ability to choose who you want, a good working professional. The seller could choose their uncle or their cousin to fix the stuff, and by all means, they could do that. That you're requesting them to repair it. And as long as the repairs get done, they're off the hook. So the better alternative, what I've seen in this market work very well, is the sellers and the buyers agree to a remediation price, either in the form of a credit or a price reduction in the overall price of the home, and that satisfies all parties. In the very rare event that the buyers and sellers aren't able to come to some sort of agreement over the request for repairs, and assuming the buyer has their inspection contingency, they can walk away from that transaction with their earnest money deposit. In my very real experience, usually it's the agents that get in the way of the buyer and the seller. Instead of acting on and as a team and working on getting the problem solved, they start bickering with one another and they start fighting like rabid dogs, and they don't actually do anything constructive. Instead of solving the problem, they make it worse. And so my suggestion would be work with somebody that's going to help solve your problems as opposed to make the problems worse. And that just takes a good negotiator and somebody that understands how to deal with the other side. And I've had situations where the other side comes at us very aggressively, very strong, very not pleasant, but we're still able to work through it because my job here and everyone on my team, they all know that their job is to help solve problems and help bring people together. And so my suggestion would be, unless the home has something structurally wrong with it, that you don't let anything that's not structural keep you in the way of getting the home. There's always a way to resolve these problems. There's always a resolution, and it just takes two amicable parties, or one very amicable party and a great negotiator to help solve those problems. Once you've deposited the EMD and gone through the appraisal process, and by the way, you're still going to do an appraisal whether or not you have an appraisal contingency. Once the loan paperwork has all been done and everything's good, and whether or not you've done the inspections at this point, you're really close to closing. And that's what the last video in this series is going to cover. So stay tuned for part 4 of how to buy a home in Silicon Valley. But until then, everyone, this is Danny Gould with Selling Silicon Valley Group, and I will catch all of you in the next video.